Good morning and welcome to our Ashworth Wealth Weekly Market Update. My name is Scott Thomas. I'm glad to be with you this morning. I just wanted to share a little bit of information that I came across this week, and there's two things I want to cover. I want to talk about first quarter and how the markets did in the first quarter, and then I want to talk about kind of where we're at right now and what that means going into the next couple of quarters. I read an article earlier this week that I wanted to share with you, and I wanted to share a graph with you. But the article, I'm going to read directly from the article. I'm going to read just a couple of lines. And again, this is looking back at first quarter. Based on reports so far and expected results, the growth sectors are largely expected to drive pro forma earnings growth this quarter. Recent economic data have continued to underscore the strength of the U.S. economy, and we anticipate GDP grew by 2.2% annualized during the first quarter. So we continue to have good growth during the first quarter, and the markets, and particularly when we talk about the market, we look at the S&P 500, and the S&P 500 reflected that by having very good returns over the first quarter. I wanted to kind of show you, I want to show a graph here comparing where we think that growth came from, why the first quarter, why the markets were up. And if you look at this, this is a graph comparing first quarter of 2023 to first quarter of 2024. So just year over year growth. Revenues were up. So revenues this first quarter relative to last year were up almost 1%, which is very good. Margins were down just a little bit. And then the one that I also wanted to concentrate on is on that earnings per share was down just a little bit, but not much. So relatively speaking, first quarter of 2024 was good or relatively flat compared to first quarter of last year. But most companies that were reported good earnings and good growth. A couple of other things I wanted to share with you, and a couple of things that we watch very closely, and these are usually indicators of where we're headed. Everyone is watching what the Fed is doing. Are we going to have interest rate hikes? Are we going to have interest rate cuts? Are they going to leave it the same? If you had talked to any economist in third or fourth quarter of last year, most of them would have said we're going to probably have rate cuts to the interest rates at some point during 2024, and the markets reflected that, and we had a very good third and fourth quarter of last year, even a first quarter of this year. Every month as the inflation numbers come out, we watch those very closely, and we have noticed that every month that those inflation numbers have come out, they've been a little bit higher than what was anticipated or what the Fed target was. Because of that, we anticipate now that there might not be any rate cuts this year, or if there are, it might be one or two rather than the five or six that we were anticipating. So I think that's been a major drain on the markets over the last couple of weeks. The markets have kind of built in these rate cuts, and now that they may not happen, I think that's one of the reasons why the markets have been down just a little bit. On that, again, I don't know if I can't remember if I mentioned this before, but the Fed meets again on April 30th to May 1st. So that's the next time we're going to hear about where inflation is and what the plan is for rate cuts, at least for the near future. But again, we don't anticipate there being a rate cut with the inflation number a little bit higher than what they were targeting. Okay, so the next thing I wanted to talk about, I was on my way in the other day to the office and listening to just a news program, and they said, which I thought was fascinating, new home sales were actually up about 8.8% for last month. I thought that was interesting. Even though the 30-year fixed, average 30-year fixed right now is about 7.5%. That tells me that people are still buying and anticipating rates will go down. But that's going to be very interesting to see what happens over the next couple of quarters or even over the next year to what happens with interest rates. Okay, just a couple other things why I think we've had a pullback over the last, even though we had a good first quarter, we've given some of those gains back over the last couple of weeks. A couple other reasons for that. We mentioned the one is the markets were anticipating multiple rate cuts this year. We may be down to one or zero, depending on how things go over the next few months. I think that was the first drain on the markets. The second is geopolitical. We obviously have been watching the war over in Russia and Ukraine, but now we've got another conflict going on over in Israel. And finally, not finally, but for the first time, we've had direct conflict between Israel and Iran. That is very concerning to the markets. That's got very wide implications. If that were to spin out of control with oil, there's lots and lots of things that could go very badly with that. And I think the markets are watching that, and we're a little bit spooked by what happened here a couple of weeks ago. Hopefully, that situation resolves itself, and that won't be an issue going forward. But I think that's a major reason why we've given some of the gains that we had in the first quarter back over the last few weeks. The other one I want to talk about, and then we'll finish up here. The other reason I think that we've had a pullback over the last few weeks is even though companies reported better than expect across the board on average, better than expected returns, better than expected earnings, better than expected sales, they also, when companies report what they did over the last quarter, they also do forecasting for what they think is going to happen over the next quarter. And a lot of companies, even though they had good quarters during the first quarter, their outlooks were softer than anticipated. So as companies came out and downgraded or um, uh, they're looking to not do quite as well during the second, third quarter. That I think spooked the markets as well. So again, like always, we preach that we need to be diversified. The markets will continue to bounce around. We're in an election year, obviously. That's going to be, we're going to have some ups and downs. So I think we're still going to have some volatility. We're going to have volatility every time anybody talks about interest rates, as we have any kind of flare-ups in some of these conflicts around the world. But we continue to maintain that if we have a long-term focus and we continue to be diversified, that things will work out and the portfolios will be fine. If you have any questions for us, please don't hesitate to call. We can hopefully answer any questions that you have. And again, we appreciate you being with us. Thank you.